All right, good evening, guys. We just got the one question tonight. Foundations course Q&A for December 14th, 2023. So this was taking a look at the market 2 days ago. There was a 3-minute sniper trade of the day in SPY. That's this trade, and said made me question my understanding of what is meant by the phrase standard work, because I didn't take any PSAR flip exits. I didn't exit at the Bollinger Band mean. Wouldn't that make this non-standard work, exercising discretion and judgment to enter and stay in a good trade? So the idea was this was the opening of the day, harsh sell-off, morning hook. This is a Fed day. We're going to get a Fed announcement right around here. And I took a morning hook as it was on the north side of the VWAP. There's your VWAP cross. This is a Bollinger Band mean cross, and it's also a PSAR flip. So I take the standard entry here with a standard risk box here. And he's noticing that I'm not taking these exits or flips. And does that make this non-standard? The thing to remember about standard work is that there are two kinds of market conditions. There's normal and there's abnormal. And there is standard work for normal conditions. What do we do when the market is normal? And standard work for when the market is abnormal. Now, what supports all this is values, principles, tools, mindset, which is mindfulness. So the same templates and indicators and tool sets work here, but there are procedures and rules over here, and there is artful judgment on this side. And we can have different rules over here. It's just that we're making a distinction between most of the time and part of the time. So, standard work for normal conditions, I want you to think about that as you're assembling wooden furniture from a kit. And that means that we're going to use fairly strict procedures, rules, and templates. We're going to use our SOP. Trainable. There is standard work for abnormal conditions. But in this case, it's like we are carving a unique project out of wood with a focus on mindfulness and risk management, like an artistic craftsman. And we're working with the artistic craftsman's feel for working through chaos, complexity. We'll be using the same standard tools and templates for setups, but it's a world of difference because of the abnormality, the chaos, the complexity. So, in the basic course, what we're teaching is uh, we're teaching you the rules and habits for normal market conditions. That's why I am not teaching you the hybrid frog and the morning hook and the frog generation rules and the RLCO and the Anderson regression line stretch. Um, We're trying to work on things that are behaving under normal market conditions. The point I want to make is that the same set of principles, values, tools, and things like safety on the job site, that's mindfulness, risk management, position sizing, zero state, checklists, rehearsals, standard trade framing. That's safety on the job site first. And that applies to both sets of working conditions. But the judgment and application of the tools can be considerably different in practice. So this means that we have to have a good understanding of when the market is in normal and when it's in abnormal conditions, and then behave according to the category of market condition that it's in, always being governed by risk management, mindfulness, and math. Now, yesterday was a planned Fed announcement. The market always explodes immediately after the Fed announcement. That is the very definition of abnormal conditions. So when I look at an entire trading day from open to the Fed, who announces at 2 p.m., this is where the explosion occurs. This is maximum volatility in both directions as it sorts out a response, and traders respond to other traders' response. And so that's the definition of abnormal. There's also abnormal behavior prior to the announcement of the Fed. Like, it is not unusual to see quiet directional trading until about an hour before the Fed, and then whichever way it went, whoever the winning trade was, like in this case, if it was on the long side, it's not unusual to see that come back to zero, as the guys that were brave enough to trade on Fed Day in this area want to cash their win before the Fed announces. So you see some kind of low volume morning move with a return back to the zero line. That is almost reliable, and that's abnormal compared to the other 21 trading days in a standard month. So taken together, the entire Fed day is abnormal, but it's weird leading up to the Fed, and then it is extraordinarily volatile in the afternoon. So what I want you to see, here's what I said about that trade. Let's see if we can get this rascal up in here. All right. So what you see below is a standard entry and a relaxed single position with a wide stop. Like if I was going to play this on a non-Fed day, I'd be looking at second positions around here. Either at the COTA 2 or at the 2R battle drill. I'd be looking at an exit here because I have a long side bias because of the wind, probably a COTA 2 here, probably a scratch here, a Kata 2 reentry here, a 2R battle drill here, and then an exit here. So I'd probably have that kind of segmented trade. Getting multiple positions on. But all I'm trying to do is get a single relaxed position with a wide stop. And then, as long as we're in the money and price is north of the VWAP, I'm good to go with the VWAP being the trailing stop. As long as I'm in the money, I'm okay with that as a trailing stop on Fed day, because when the Fed announces somewhere around in here, I want to have a cushion of market's money, and I want to see how it reacts. Now, under most market Fed days, the expected behavior would be right around in here, would be to see that thing come back, as there should be selling pressure in order to capture the wins that a guy made to here. So that's everybody who entered early is holding this kind of win. So they know there's going to be volatility on a Fed day. So normal behavior would be to see at least a 50% retracement. But there wasn't. It went straight into the Fed announcement, and then it exploded. It's almost as if somebody knew. It would be interesting to see how the members of Congress made out yesterday. And then this thing, now normally on a Fed day, you'll see an announcement and it'll move harsh in one direction, harsh in the other direction, harsh back to the middle, and then you end up seeing which way is it going to go. Is it going to follow through for the rest of the day here or here? But you normally get 2 to 3 volatile gyrations. And in fact, one of the things that we do in the advanced day trading course is we talk about the Fed ambush trap, in which we bracket the price right around the Fed's announcement with a series of we put a bracket order in here of 5 positions long and 5 positions short, followed by selling one at these different levels to lock in price, because and then buying positions to cover like this. And then we wrap that in a complex order with the broker so that you can just drop the whole bundle on there. And then what happens is, if this thing breaks out, you get 5 positions long, and then you start peeling things off until it starts to reverse. And then you grab this, and you, using visual trading on the chart, you drag that whole thing up. So then you become short 5, and then you start buying to cover. And that way we use this complex order and visual trading on the chart to get rapid fills on these breakouts, no matter which way it goes. Then when it settles down, we've earned some money here in order to start funding the directional trades. That's how we normally trade a Fed day. Now that is not the same as standard work for normal market conditions, but normal market conditions don't look like that. But this is standard work for abnormal market conditions. We just make that a battle drill. It's an advanced technique, and of all the days, in the market, and there's 22 trading days in a month and 66 trading days in a quarter, only one of them has a Fed announcement. So that's 1.5% of the time you're going to have a Fed day. So the rules that we use on a Fed day are not appropriate for normal market days. And the same rules that we use for standard work in here are not going to be the same that we might use on that day. I'm going to use the same frames and wrist boxes and indicators. I'm just going to use different rules about trying to get second or third position. I'm just trying to get started with one so that I have skin in the game and maybe I can earn some money on a wide stop going into the Fed announcement. At the same time, there's some artful judgment that is required. For instance, the observation that instead of right here, where I would normally expect it to fade back to the VWAP, there was more buying pressure consistently going right into the Fed. And boom, it just went directionally long. As if somebody knew that it was not going to return to the VWAP and that it was not going to react all the way back down. So the failure to fail was information which starts filling in the market mosaic. When we're doing artful judgment, we're taking different pieces and parts of the information mosaic and trying to come to some conclusions and filling in the gaps with our artistic judgment to figure out what's going on and come up with a strategy that might work for this short period of time. That is standard work for an abnormal market condition. The other thing to notice, and this is part of the longer term market condition, is this is a time when the market has just completed a historic 30-day gain. And all of the look back periods are abnormally overbought, check. Volatility is extremely favorable for positive, sharp swing moves, check. And the short term conditions, like 10 days, are all in a compound critical state, check, check, and check. This is the fireworks setup in the sniper when you have something like an extraordinary move well beyond normal limits. Like if this is the average 30-day move and this is average plus one standard deviation, everything up in here is truly abnormal. Well, that's where we are. And it had only pulled back a tiny little bit and got into the tightest little 10-day sideways trading range that you could imagine. So now in the fireworks, we treat that as a compound critical state. Are we going to get a second boom, or is it going to come crashing to earth after the Fed makes an announcement? So you start combining all of those pieces together, and that creates the conditions for an extraordinary move that we were prepared for, because that's the kind of standard market analysis that we do under abnormal conditions. So if this was the first big boom, the 30-day move, and we're waiting breathlessly to see if they have another surprising secondary boom, that's what this consolidated low volatility 10 days is like. That's what the Fed consolidation is like. We're waiting in silence with tension and urgency rising, and then yesterday, boom, the Fed. They said, hey, we're leaning towards a 75 basis point lowering of interest rates for the next year. Now, why is that interesting? Well, that's interesting because the Fed is making a commitment like in January of 2024 and forward. Over the next 9 months, they're looking to cut 75 basis points out of the interest rate. What's that going to do? There's a bunch of things that are going to go up, like real estate, stocks. Who is that? What's happening in November of 2024? A freaking national election of historic proportions. So now the Fed just voted to level the playing field between Republicans who have been in ascendance and the Democrats who can't find their way out of a hole in the ground with a ladder. And the economy, nobody loves the economy except economists. So this, all of a sudden, makes this a crapshoot and fills the market full of optimism that the administration is going to be committed to do whatever they can to offset the Republicans' economic advantages with policy changes. That's going to be good for the markets. And what did it do yesterday? It responded to that. Well, If the market did that yesterday, what's my play for the overnight session? I'm going to be long the things that made the most money during this segment and the things that are likely to have an advantage going forward, like real estate, regional banks, the broad market, international markets who are going to buy things and sell things to the U.S. So we talked about that last night. I identified a bunch of symbols that I said should have a chance to do really well. I said Caterpillar, AI, KRE, real estate, emerging markets, Intel. Let's take a look at the ones that did well today. Oh, I also mentioned the metals. Alcoa, 15%, Rivian, 14%, AI, 12%, clean energy, Caterpillar, Tesla, real estate, Cliff, between 4 and 6%, IP, 2%. All of these are better than the broad market itself. U.S. Steel, Intel, emerging markets. Those are the ones that were in compound critical states and had reasons to do well. So what did we get today? We got the second boom. Just as an example, here's Alcoa. So this was Alcoa's move yesterday. This was the open. We got a 1, 2, 3 entry. The Fed made their announcement here, and Alcoa did that and closed here. 4, 5, 6. So we got a 6R win in Alcoa yesterday. And we said, be ready for that one tomorrow. In other words, today. And what does it do? It gaps up to here and then takes off. And finally, I get a second position and a third position, and I'm still holding that one. So on the initial risk in Alcoa from yesterday, we're holding more than 20R on this one position, and the swing position from here has earned 1, 2, 3, 4, 6, 7, 8, and this one's earned plus 4. So that's a 32R trade on a swing trade in Alcoa. Is this thing showing any signs of suffering? No. Is tomorrow a possibility? Yeah, that's in play. It sure is. The ones that we said yesterday were strange. The two symbols yesterday that didn't work was McDonald's and Microsoft. It was weird. And we said Walmart was close to being done. And what did we get today? Walmart, Coke, McDonald's, Microsoft, negative for the day. So getting the market and sector short-term estimate approximately correct gives you a chance to make extraordinary moves or extraordinary gains off the extreme. Here's the market was not much. It was up 0.32. This was up 15 times, 45 times larger was the move. $50 times larger, 0.3 versus 15%. So today was a abnormal day right from the opening. I was prepared for an abnormal day, which means that I'm focusing on the ones that should be doing the best, and I'm ready to get positions on based on the initial movement right from the opening. Yeah, so that's it. So that's what I wanted to say, that in the foundations course we are equipping you to be broadly exposed to the basics, you know, the principles, methods, models, checklists, psychology, tools, indicators, standard rule sets for normal market conditions. And cautioning you, don't trade on Fed days if you're not prepared for abnormal conditions. You can see this same kind of mindset when I talk about exits. I said from the time you enter, oops, to the time you get your average win, by the time you get to an average win, your exit strategy should probably have you locked in with a no lose plus dinner for two. That's always good advice for normal. That's also good advice, by the way, for abnormal. The advice for abnormal is just as soon as I can, get my initial risk out of there just so that I don't get whipsawed or murdered. But under normal market conditions, we would normally expect that to be a standard grinding kind of a move. It would be unusual for that thing to just explode like a rocket ship. But under abnormal conditions, I'm prepared for a rocket ship move. And by the same token, if I get to average plus one standard deviation, a move from 0 to average win plus 1 SD, that's the definition of normal. So until I get an average win plus 1 SD, I'm not even really invoking the sniper exit strategies. I'm just using standard rules for normal behavior. Once I get past average plus 1 SD, that's where I start bringing in the sniper exit, where I'm going to take one half of the position off with the sniper and one half off with the managerial exit. That's the Wu-Wei exit, by the way. Because now I don't have to think about all or nothing. I can just, what I end up getting in that kind of condition is the average between the managerial exit and the sniper exit over time, because I'm getting half of each exit strategy. So when we're reading the market conditions and sector conditions and the daily report, we're looking for conditions that, why is it normal? Is it abnormal? What's creating windows of exceptional opportunity? Now, what I'm always trying to do is find something that's in a compound critical state. Why? Because when the market's in a normal condition, it's just cruising along like this. But I have a target that's in a compound critical state. That one is more likely to make an explosive move than the broad market. And so by comparison, this will seem to be really exceptional. And there may be some even additional momentum because it's standing out as such a difference compared to the broad market. But when the market itself is in a compound critical state, like on a Fed day and the day after a Fed day when it had this kind of a move, man, all bets are off. That's such an amazing situation. And that's why, if you listen last night, I didn't spend much time looking at the rest of the report. What I said was all you really need to know for tomorrow is to be prepared for large moves, and you might want to concentrate on things that were really good today, like Caterpillar, Alcoa, U.S. Steel, Cliff, Intel, IP, that kind of stuff. So that's what I wanted to say about standard work. The whole idea of standard work is that remember the world falls into a range between normal and abnormal. There's some uh, range like if we look at volatility, if that's the average volatility between +1 and -1, it's those in the sniper. I'm looking at moments of exceptional volatility as abnormal plus and exceptionally quiet is abnormal minus. It's from those two areas that the biggest surprises of big moves typically occurs. So I combine location, where it is in those various look back periods, where is it in the 150 day, the 30 day, and the 10 day, plus what's the volatility characteristics? Is it exceptionally quiet or is it exceptionally volatile? So if I get multiple look back locations that are at an extreme and an extreme volatility, that gives me a compound critical state target, which is hopefully in a little doji or something, and then the breakouts become exceptional and become emotional. That's why we focus on standard work. Questions?
Yeah, I have one on the critical state.
Yeah.
I've been following it, but do you do that off a critical state? Look at it from the daily, or are you looking at it on the 330-minute chart?
I set them up for the daily, and the reason for that is because there's a lot more money connected to the daily chart in swing trades and core trades, the long term. There's so much more money tied into those conditions than the amount of money that's in day trading. Like there's a certain number of guys that are pro day traders, but a lot of that is just trading back and forth between each other, and it at the end of the day it goes up big and then down big. It opens here, went up big, went down big, and then comes back, and then the amount of net change is really small. So the day traders are exchanging money between the high and the low, but between open and close, that's usually not a huge move. So I like looking for things that are in critical states based on where the core, the 150 day and 30 days, when those are at exceptional, then if it's a large volatility on the short term, 5 day or a 1 day doji, this one's already in play, so it's moving large on the daily. Then I can go down to the 30-minute chart and I can refine my entry. And like on the example with the S&P yesterday, it sold off quick and then recovered, and I was able to get a long position, and then that thing just kept marching. If I wait for the end of the day, then I don't get any of that. And if I had entered on the at the close of the day before, I don't get to see any of this information in here. So the 30-minute lets me see, let's see, 13 and a half, like 13 or 14 bars a day inside a single day. Whereas on a day chart, I only get one bar, open, high, low, close. I get 13 and a half or 14 bars for the 30-minute thing to unwind and form patterns, and that is tradable. But I'm using multiple time frames because I'm looking at a breakout above the previous day's high is exceptional. That's important information. And a breakdown below yesterday's low is important information. So in this little example, the fact that it broke out here, that's new information that's exploitable, and I still have this much time to be able to exploit it before the market closes. Now, I can also look at a 30-minute chart and realize that, hey, this thing is coming into it had a nice big run up, and now it is getting sideways quiet channel. And so the Bollinger Bands look like this, very wide. And now on a 30-minute chart, the Bollinger Bands are getting really tight. And so if this was a large move and this is less than a frog box, by definition, I have a compound, I have a critical, I have a critical state here. What I want is a compound critical state, which means that there's multiple time frames that are looking at this as an important price level. And the best example is like on breakouts, like where we are right now on the 150-day look back. The market is in overbought conditions on the 150-day look back and the 30-day look back and the 10-day look back. So when it exploded today, that means everybody who's a long-term buy and holder took notice of a new 150-day high. So they're activated to do something with their money. But if price had just been in, let's say this is where the 10-day range was, and it closed in the top 10%. Well, the 10-day look back guys think this is important, but the 150-day and the 30-day guys don't care because this price doesn't mean anything to them. It's just in the middle of their trading range. So they don't have an extra reason to respond in an emotional manner. But when it's a triple top, if you will, in the top 10% of the 10-day and the 30-day and the 150-day, that makes it an exceptional compound critical state for location. By the same token, we've had times where it's near the top of the 150-day look back, but the 10-day look back was at the bottom of that. So the short-term guys are ready for this thing to collapse. The long-term guys are ready for that thing to go. Both of them, if it breaks out or breaks down, both of them have a reason to react. Compound critical state. So, did I answer that question? The daily chart is the one
Yes.
that I'm doing. I start with, and I think the best way to start is always with the daily report, end of day charts, daily bars, and I start with the swing trade frames and any swing trade contributions because I can accelerate my time and go look at the opportunity to day trade them with turbo, but it may also help me. This could be a turbo trade on a core position. So the swing trade gives me information about my core positions and also about my day trading positions. And this one gives me positions that are 2 to 10 days long. The theme of the trade could last for as much as 2 weeks. And so I can get information like yesterday that this is going to have information for the next 7 days. The information about the Fed on a Wednesday affected today's trade on a Thursday. It's going to affect tomorrow because there was a big, and then everybody over the weekend's going to be thinking about it for 2 days. And then next week, Monday through Friday, is going to be at a higher energy level because everybody's going to say, oh man, this was an amazing move up. I wonder if that's going to carry over into this week. So the fact that the Fed was so extraordinary yesterday, that could have a duration of 2 to 10 days in length. So I can have an updated long side bias for some symbols in the market that lasts me for 2 weeks. That's a very efficient way to develop my bias for the daily trade tomorrow. In that same period of time, we could see volatility go from very large to another quiet move. Like we had something like an amazing 30-day trade where the slope of the RL30 was extraordinarily high. It was a 2 standard deviation upward move. That's an extraordinary move. And then for the last 10 days, that thing has been flat sideways in a very narrow range compression kind of a condition. Just as this was abnormally strong, this was abnormally quiet. That makes this, what is the Fed going to do? They announced 75 basis points. We made a great big shift. Boom. Boom goes the market. But they may have said something completely different. And if the market had started to collapse yesterday, it would not have been surprising to see a bunch of fear based momentum go this way as people were looking back and trying to preserve, oh, I need to save half of that upward move. I want to make sure that I preserve this move. And so they may have put a bunch of selling right here, to lock in half of the gains. Well, if the market had sold off yesterday and today and then hit this, hitting all of those stops could have caused the market to collapse completely. That's why the swing trade is so interesting, because you get these large, reliable oscillations. And if you take a look at the last 3 years of the market, after COVID, the oscillation of the RL30 slope, before COVID, it was it would just oscillate like this between plus and minus 1 standard deviation. And now after COVID, it's been doing this, meaning that the amplitude is huge and the frequency is huge. Whereas these were long, slow, shallow, or short waves, these are frequent, much more frequent, and much taller waves. This favors swing trading, and it has been a swing trading market for almost 3 years. So I frame the market in terms of swing trade opportunities by using mechanical symbols or mechanical signals plus discretionary signals, or the hybrid patterns, by taking a look at the RL10s and the RL30 turning points and trying to use those to get the call right so I can see swing trades down and swing trades up. Right now we're in a swing trade up. All right. Did I answer that enough?
Yes, thanks.
Okay. All right. All right, that's everything I wanted to cover today. Um, the follow through in in the hybrids today were just astronomical. I mean, Alcoa, AI, Amazon. Now Amazon's one that did not follow through, so it cashed yesterday's big up move. Caterpillar was extraordinary. Look how good Caterpillar. This was the entry yesterday on the morning of the Fed. It never looked back yesterday, and today gapped up and just blew up and then closed way up in here. That's Caterpillar, for crying out loud. That's a 30R trade in Caterpillar. Greg says a question on the SSC 2R battle drill long reentry. On which one? The S&P?
I'll ask the question. It's a super quick one. I'm sure it's been asked a million times. If you have an SSC pattern, you get stopped out. You're going to do your 2R battle drill. It's a long, so you're doing a long reentry. On that reentry, where are you placing the stop, the actual executable stop again?
All right. The reentry after an SSC. All right. Well, first of all, the SSC had to cash a winning trade. Check or hold.
Okay.
So we got long. It made a move. There was some retracement that caused us to get out.
You
Fair?
know what? Let's say what if it wasn't a winning trade?
Then there's no reentry.
Check. Okay.
Because
Okay.
because
Uh,
it if this is not a winning trade, then it should be. I should be stalking a collapsing dragon. This has to be a winning trade to be a reentry, which means that the R10 had to come to a peak and roll over, and then there was enough of a retracement that triggered an exit. Let's say that was a break. Let's say that was the PSAR, because it probably looked like this. And price came down through the PSAR. Exit. Now, what's it going to do? I already know if I'm going to take a short position in here. Usually not. I know what it takes to get back in on the long side. What it takes to get back in on the long side is a COTA 2. That means the RL10, which peaked, had to come down and then make a higher low. Compared to this. Higher low, and successful trade, higher low. The RL10 reversed, crossed the dragon. RLXD entry. That's a COTA 2 entry, which is a re-entry after a successful SSC. Even if I didn't take this trade, like I looked at it and said, I don't want to take it, I don't have time, willpower, or money, and I notice this thing setting up, I can look back and say, well, that was a successful SSC pattern, and now I'm getting this move with a higher low. The RL10 is facing upward, and now I either got to get in when it crosses the dragon or when it crosses above the peak of the RL10, which makes it an emerging dragon. So I'm either going to get in here, but not later than here. So my room for discretionary entry is in this yellow zone. My stop is the bottom where the RL10 peaked right here. I trade between the peak and the 2 points of the RL10. Where the RL10 turns is always where the PSAR flips. That's always going to be my exit. My entry is going to be after that thing crosses the dragon. And that's going to be my risk box.
Makes sense. I was just concerned about there were events where the price was just crazy in volume and it would just spike all the way down and then spike all the way up. So on the initial SSC.
So abnormal. You know, if it's that crazy, don't trade it. I'm not looking for reasons to trade. I'm looking for reasons not to trade. It almost is where I can't not trade it. I have to trade it. I want to be dragged kicking and screaming into it. Is
Fair
my
enough. All
mentality.
right. Thank you.
All right. That's everything we got for today.